Private markets are part of the larger universum of alternative investments, which can be defined as investments other than ownership of public equity securities, fixed income instruments, or cash that we refer to as the more traditional asset classes. Investors often turn to alternative investments for diversification and higher returns, accepting illiquid, long-term commitments in less efficient markets. These assets require specialized expertise to assess and involve unique considerations for portfolio inclusion. Private capital refers to funding sourced outside public markets, encompassing private equity and private debt. Managers use private ownership's flexibility to implement strategic changes like restructuring operations, selling divisions, or overhauling management to boost profitability over years. Venture capital, a subset of private equity, funds early-stage startups with limited operations but growth potential. Private equity strategies include leveraged buyouts, LBOs, venture capital, and growth capital. LBOs involve acquiring companies often mature, undervalued, or struggling, using substantial debt secured by the target's assets, with the goal of restructuring operations to boost profitability before exiting. These transactions often turn public companies private, termed going private deals, or involve established private firms. Variations include management buyouts, MBOs, where existing leadership participates, and buy-ins, management buy-ins, where external managers take over. Private equity managers drive value by improving operations, cutting costs, pursuing acquisitions, or reorganizing business lines. Returns are amplified through leverage, though reliance on debt makes LBOs sensitive to financing costs and market conditions. Funds hold portfolios of such investments, with companies referred to as portfolio companies. Like public equity, private equity grants ownership rights, dividends, and voting power. However, private investors exert greater control, directly influencing strategy due to concentrated stakes, unlike public shareholders, who rely on disclosed reports. Returns primarily stem from capital gains via asset appreciation or cash flow growth. Equity investments, public or private, historically carry higher risk-return potential than debt, offering unlimited upside but capping losses at the initial investment. Private equity demands specialized expertise due to its hands-on, illiquid nature, contrasting with public equity's liquidity and passive ownership structure.